Hey everyone, hope you're having a good day. Joe here. Just wanted to provide you with a little bit of a market update. I know that there's been a lot of talk about the real estate market in local news, headlines, and posts all over social media about how a crash is imminent. The prices are going to bottom out, the floor is going to open, and all sorts of negative talk about the real estate market. So today in this video, I'm going to try to, as efficiently as possible, cover some of the main things that have to do with the current market that we're in. So in this video, we're going to cover inventory and the current supply. We're also going to cover things like the interest rate, population and demographics, and we're also going to talk about the average pricing here in LA County. One thing before we get into the material that I would like to discuss, or at least touch on, is the fact that you need to take things that you hear with a grain of salt, especially if they're coming from news outlets, social media, or other people on YouTube like me. Now, there's a lot of people on YouTube that make a lot of money by embellishing lots of things. So again, just remember to look where the information is coming from, and if they're a trustworthy individual or source, keep that in mind. And if you ever have any questions, always try to locate a competent real estate professional in your local area. Which takes me to my next point that I want to bring up. Real estate is hyper local. You cannot rest on the headlines of the nation to dictate the information about your local market. Heck, even the market from Los Angeles County to San Bernardino County to Orange County is vastly different. So how can a headline that's written by a news company in the Midwest apply to everywhere in the United States? Well, it simply can't. The other thing that we're seeing kind of major news headlines do, or come up with these amazing sort of show-stopping statistics. Things like, oh, foreclosures are up 118%, and year-over-year pricing. You'll hear that one a lot. Year-over-year sales are down 48%. Year-over-year sale prices are down 30%. Well, another thing to keep in mind: real estate's hyper-local. Number one. Number two, it's also very seasonal. And right now is really not the season for real estate. Even here in sunny Southern California, as you probably know, we had a bunch of rain pretty much all throughout the month of December and half of January. Temperatures are very cold. We had the holidays. It's historically proven that from October, November, December, and January, there's just not a lot of real estate action. So again, just a lot of things to keep in mind when you're sifting through all this information, and nothing takes the place of a local industry professional that knows what they're talking about. So the first thing you're going to see on your screen is a graph that talks about inventory in months supply. Inventory is just that. It's how much available supply we have. It's measured in months. So if we had 1 month worth of inventory, that would mean if no new properties came onto the market for 1 month, we could fulfill the pool of buyers that were there. Typically, we see anywhere from about 3 to 5 months worth of inventory. And when it gets to 6 months and above, you're talking about a buyer's market where there's more homes on the market than really available buyers that are out there. As you can see on the graph, if you look all the way at the right side, that's about where we are at this point in time. So that's late January 2022. I'm sorry, January 2023. And it's very low. Inventory is incredibly low. We're at just over 2 months supply. Again, we're normally in the 4, 5, 6 months range. That's typically where we see the levels of inventory. Now, how do we take this information and make a judgment call about a possible real estate crash? Well, if you look over on the left side of the graph, you're going to see that back in January of 2008, our inventory in months of supply was almost 14. So keep in mind, we're just above 2. Let's just say 2 to make it a round number. Our inventory in 2008 was much higher, in the realm of 7 times higher than the inventory that we have available now. So it's the old supply and demand. There's just less supply. And while right now demand is lower because of interest rates, the supply remains very low. If this supply was higher, closer to 5, 6 months, and if this supply was trending upward to indicate more supply coming online, then we might be a little bit more worried about a potential real estate crash. With these current inventory levels, this just does not indicate that there's going to be a major falling out in the market. The next thing we want to talk about, which you're going to see up on your screen, is the average sales price. So this is kind of interesting to look at. It really does demonstrate how quickly property boomed during the pandemic, and that's what I want to hit on. You'll see that starting in January of 2020, this graph basically takes off like a rocket. And it goes up from about your average sales price being about $850,000 in Los Angeles County, and skyrocketing up to well into almost 1.3 million or so. That's quite a bit of growth. The thing to keep in mind here, though, is as we are on the downside and prices are receding a little bit, we're seeing a much more stabilized pricing, and it's not coming down as far as, again, some of the headlines would lead you to believe. A lot of the headlines are going to say, oh, prices down 20%, 25%. Well, that's because they're up more than that. So basic math will tell us if a property goes up 30% in value and drops 25% in value over the next 6 months, well, you're still 5% up overall, which is actually kind of in line with the normal appreciation of real estate. And the next thing that you'll see on the screen is equity and the average homeowner equity on mortgaged homes in the United States. Based on this much equity, it's hard to have a lot of foreclosures, which is what people think are coming up. A lot of people will say, oh, the foreclosures are coming. They're coming. Just all that forbearance is going to catch up. And while, yes, people's homes will be foreclosed on, that happens all the time in a normal market. Now, it's to what extent. And something that's really, really important is it's a stat that I got from Axios, which is where this graph comes from, and I want to read it to you. So this stat says the average borrower has, on paper, lost about $30,000 equity from earlier this year. So from January 1st, 2023, well, this is back in 2022. So from, say, January 1st, 2022 till the time this was published, which was late in 2022, so almost a full year later, they lost about $30,000 in equity. Well, that's not great. Nobody ever wants to lose $30,000 in equity, but they still have more than $92,000 in equity than they did in February of 2020. So they still have $92,000 more dollars in equity than they did pre-pandemic. So yes, again, this goes back to sort of the average sales price. Yes, it's come down, but the overall gains are still way up than they were pre-pandemic or even into the pandemic. People have equity in their homes. It's hard for them to foreclose. In order to foreclose, you really need to be underwater, which means you owe more than the house is worth. In order for people to have their equity gains wiped out, the prices of houses would have to go down 30 and 40 and 50% before we really start to see a major shift. And there's just no indication of that happening. The next thing I want to touch on is, well, frankly, why we don't expect a crash to come, and that has to do mostly with demand. So one thing that I want to bring up in this segment is the population and the home buying age. Typically, home buying age is around 31, 32, 33 years old. Well, I'm going to bring up the M word, millennials. So millennials are right in that meaty portion of the curve. Right now, I'm a millennial, fellow millennial realtor. So of the home buying generations, millennials are the biggest. And in that segment of millennials, the largest group of millennials are those ages 29 to 34, right in that meaty portion of the home buying age. So this is why we do expect demand to continue. Our population is still increasing. Millennials are very, very open about wanting to own a home and wanting to buy a home. And that's why I personally think that we're going to continue to see demand. We have just such a large number of people that they all have to live somewhere. And whether that's renting or buying, someone's got to own the real estate. And millennials are a big demographic. In addition to that, another thing that we can see, as you'll see the next chart on your screen, that's going to lead to increased demand is, again, this has to go back to where we started, inventory. But now we're going to talk about single-family housing units completed. So these are new homes they're building. This is brand new supply. This isn't in the resale market. So this is a very interesting graph for a couple of reasons. You'll see the dotted line through the middle of the graph there is the long-term average. And that's the average number of homes over the course of, well, over 35 years that the U.S. typically builds and completes per year. As you'll see, in 2002, 3, 4, and 5, we had 4 consecutive years of record-setting number units of completion. That means that in those 4 years, we had the highest number of homes ever completed at any time. That translates to a very high amount of inventory. Again, right now we have low inventory, and during this time in the 2008 crash, it was very high inventory. Well, after 2008, in the years to follow, 2009, 10, 11, a lot of builders got out of the real estate game. So what did that lead to? Well, as you can see, in around 2009, 2010, we start to really hit a low point in new homes being built. And as you see on your screen, 13 straight years below our 50-year average. So for 13 years, we were below average in producing new housing units. So not only are we low on inventory on the resale side of housing, but we're also very low on inventory on the new build side of housing. And not only are we currently low, but historically low. It's going to take a long time to pull this average up, and we're going to need to have multiple consecutive years of above average building to even this out. And that, again, is why I think we are probably going to see a relatively strong real estate market for at least the next few years and beyond. We just don't have very much supply. We don't have a lot of inventory, and I don't see demand waning all that much. Lastly, we're going to talk about the I word, interest. So interest rates are really popular right now. They've been all over the news. People talking about, oh, the rates are going to go up, the rates are going to go up, the rates are going to go up. Well, actually, they just ticked down as of about last Friday. Every Friday we get an interest rate update, and they actually ticked down, and they're just over 6% right now. And if you're a qualified buyer, you might even see that 6% figure pop up. And it's really important to look at this graph. As you can see, the interest rates are noted in the blue, and they are ticking up. The thing that's ticking up higher, though, is that orange line, which is the average sale price of houses sold in the western region of the United States. But furthermore, what I want you guys to look at is on this graph, you'll see in the background behind the lines, there are multiple widths of gray shaded segments. And all of those gray segments are US recessions. And we need to take a look at a few things. Throughout most of the recessions that we had, and this graph, as we can see, shows 1, 2, 3, 4, 5, 6 recessions. And through most of those 6, we see 2 things, and they're related. You'll see that the blue line, which indicates the mortgage rate, typically goes down during a recession, or it goes down coming out of the recession. The second thing is the orange line, the average sale price. During a recession, it ticks up and down. So it depends on what the recession is doing and what the factors of that recession are. The low interest rate will bring buyers back in and re-engage them, and the low inventory should keep prices stable. The only way we could have a real crisis in the real estate market would be if inventory shot way up and interest rates didn't do anything. Then we could have some problems. The other issue would be if we had witnessed a very large number of unemployment. Again, a lot of things to consider. And before we close out this video, again, want to remind people, this is just my advice. This is just my opinion. I don't know what's going to happen. I don't have a crystal ball. A lot of my clients ask me, Joe, is now a good time to buy or sell? Joe, what are interest rates going to do? And I always reply to them, if I knew what the market was going to do, I would be on a beach enjoying a drink and watching the sunset right now, because I would just be investing my money in the market. The truth is, nobody knows what's going to happen. The truth is, nobody can tell you if now is the right time for you to buy or sell your home. The only person who can dictate that is you. You can't listen to the noise that is on Facebook and Instagram, and please don't listen to videos on TikTok, because those people only care about your views and your likes. I really hope you guys found this video useful. I know this is a little bit longer than I like to go, but this is some good information. This is a hot topic right now, and this is some material that I want you guys to all carry with you. If you found this video helpful, please do me a huge favor. Hit that subscribe button, hit the like button, please leave a comment. Let me know. What do you think about this? Do you think I'm way off base? Do you think I'm completely wrong? Are you convinced that there's going to be a housing crash? Are you looking to buy or sell? Give me your thoughts. Pop in the comments. Share this video with your friends. I really hope you enjoyed the content. As always, hope y'all are doing well out there. Have a great rest of your day, and I'll see you on the next video.